Okay, everybody, let's have a look at the multiple choice questions for exam 1, chapters 11, 15, and 12. I'm going to go through these fairly quickly, but we'll get you the answers so you know what you were supposed to get to. So first of all, investments of assets into a partnership are recorded at current market value. It's right out of page 666. Question 2, characteristics of a partnership. It states that every partner can bind the business to a contract within the scope of the partnership's regular business operations is called mutual agency. Have a look at page 662 for that. Contingent liability that is likely and can be reasonably estimated should be accrued with a journal entry. We're conservative and we want to make sure that we're clear and tell everybody about all the bad stuff that could potentially come down the pipe. Have a look at page 615 specifically for that one. 4, if the partnership agreement does not state how profits and losses are divided, then by law, partners must share their profits and losses equally. So that's C, equally. 5, warranty expense. It's debited, and it's debited in the period the revenue from selling the product was earned, which was C. Now 6, a contingent gain that is likely and can be reasonably estimated still is not, we don't do anything with it until we actually get the money. So it's C, and that's straight out of page 615 again. Continuing on here, this was a warranty expense question, and it talks about the warranty payable account. And we know that during the year there's 190,000 in sales and 3,200 of warranty repair payments, and there's an estimated warranty expense of 1.5% of sales. So at the end of the year, what's the balance in the warranty expense account? Well, it's 1.5% times 190,000, which is 2,850, and it's a debit warranty expense. So that's the number C. That's what you should have had was C. And then at the end of the, what was the balance in the estimated warranty payable account? Well, we know it starts at 1,400. We know that we add 2,850. That's the other side of this journal entry. So we add 2,850 to it, and we subtract whatever we did pay, which was the 3,200. You'll find out that you'll end up at a credit of 1,050. So that's B. Limited partnership. This one's right out of the book, page 664. Must have at least one general partner, so it's B. 10, a partnership balance sheet includes, and again, this is right out of the book, 667, an ending capital account balance for each partner. All of the following are forms of employee compensation, except you read through it. In fact, look at page 629. A subcontractor fee is not employee compensation because subcontractors are not employees. Number 12 here, and be careful, what is the required is what is the balance in the capital account of Roos? So, okay, let's see what happens here. Canfield invests 20,000 in inventory and all that stuff into the partnership. In addition, Canfield invests land with the cost of this and the current market value of that, blah, blah, blah. The important thing is not till right here. Roos invests equipment with a cost of 100 in accumulated amortization, but the current market value is the key here of 100,000. And Roos also invests inventory with current market value of 30. So 100 plus 30, because we recorded at fair market value, it should be B. It's $130,000. 13. So this is a partner's capital account calculation, and we know that we've got 80,000 as capital and 120,000 as capital for the other partner, and so we know that first of all, let's read the required. What is the amount credited to Hughes' capital account? Well, we know that there's $10,000 for service that's contributed to Hughes' capital account. Each partner gets 10% to their initial capital contributions. Capital contributions for Hugh is 80, so he gets 8,000, and Liz gets 12,000. So we spent 10, 8, and 12. So we spent a total of $30,000. That means that because there's income of 70, there's 40,000 left over, and that amount is divided equally. So 20 plus 8 plus 10 for Hugh comes to 38,000. So you should have had D, 38,000. So then this partnership here, Ross, Joey, Chandler, and Mike form a partnership, and they divide profits and losses in a 2-3-4-1 relationship, which that adds up to 10. So that's easy adding or multiplication later on. Assuming the business earned a profit of 165,000, Ross's share is what, and Mike's share is what? We know that Ross gets 2 and tenths, so it's 20%. 20% of 165 is 33,000, and Mike gets 1 or 10%, so he would get half or 165,000. That's C, 33,000, 60, and 16,500. So in this case, on 15, this company purchases property and signs a 6-year mortgage note for $60,000 at 4%. The blended monthly payments are $980 starting February the 1st. So the money's advanced January the 1st, first payment February the 1st. The journal entry on February the 1st would include and in this case, we know that there's a debit. The credit is to cash, and the debits are interest and mortgage payable. If you look at this, it can't be mortgage payable for $980 because that would mean the whole payment goes to principal, but we know we're paying interest. And if you calculate the interest, 60,000 times 4% times 1 month, you'll end up with $200. So it's a debit to interest expense of $200 right here. So for question 15. Question 16 is talking about the criteria for a capital lease and saying all of them qualify, all the following would qualify for as a capital lease except, and it's right out of the book, page 845, the lessor retains the usual risks and rewards of owning the leased asset. In this case, no, it's not the lessor or the owner that retains the risks and rewards. It's the renter or lessee that enjoys the risks and the rewards, or retains the risks and rewards. So it was C. 2017, Camparound Canada had 24 employees who are paid on a monthly basis. For the most part, they're for the gross earnings, it was $68,000. Income tax is 15% of gross, CPP is 4.95%, and EI is 1.63%. Add all those percents up, and you get 21.58%. Each of the employees have $15 per month withheld for charitable contributions. We know there are 24 employees, and $15 a month is coming off. So that's $360 when you do the math. So we know we gross 68. We take off 21.58%. And if you do that, you'll see that 21.58% times 68,000 is $14,674.40. Take off the $360 worth of charitable contributions. You're going to end up at $52,965.60, which was C. Continuing on, got a $10,000 90-day 12% note payable. It was issued on November the 1st, 2019. What's the maturity value of the note? Well, the $10,000, first of all, makes up part of it. But a 90-day 12% note means take $10,000 times 12% times 90 divided by 365. You'll get $295.89 in interest. But don't forget, here's the $10,000 face amount. So you needed to get to D, $10,295.89. That's the amount, the maturity value of the note, which includes the principal. So George's Groceries signed an operating lease June 1 for a piece of equipment moved back to inventory. It's a 5-year lease, but we just skipped over the most important part here. It's an operating lease. It's not a capital lease. They tell you it's an operating lease. But it's a 5-year lease, calls for monthly payments of $340. First payment made immediately. What account would be debited in the entry to record George's first monthly lease payment on June 1st? It's lease expense. It's an operating lease, so that's right out of the book. It's a lease expense C, and it's for the month of June, so we would write it off. There's no prepaid in this case. And finally, Superior Spirit Corp. Borrowed $600,000 in the form of a mortgage on January the 1st to finance the purchase of a large building. Mortgage rate 6%, term 20 years. And we're making semi-annual payments of $25,957.43 on January 1st and January 31st. So we got this chart of the first 5 mortgage payments. So it asks, what's the current portion of the mortgage at December 31st, 2020? So when you look at that, you got to say, okay, what payments then are going to be made in 2021, calendar year 2021, because we've cut it off December the 31st. So if you were to draw a line right here after July 1st, 2020, then it's this payment right here, which has principal of $8,196.15, and this payment in July of $8,442.04. Add those two together, you're going to end up with $16,638.19, which is answer B. So that's the multiple choice.